Brigade presents The Realty Debate, powered by Reliance Home Finance with Manisha Natarajan.
Most pundits predicted 2016 to be a year of consolidation for Indian real estate, triggered by stressed books, slow sales, RERA and REITs. It was expected that developers with huge debt and low cash would end up bust or will be taken over by large developers, even international funds perhaps, who have interest in real estate in India. So far, there's little which has surfaced. Sure, deals with local developers tying up with large branded names like Tata Godrej do make it to the limelight, but a lot of it is going unreported. Welcome everyone to the Realty Debate on NDTV Profit Prime. We are asking some important questions today. Is the heat still simmering and are few developers likely to go belly up, or has the heat cooled off and the stressed out players have found a way out of the mess? We are joined by Irfan Razak, CMD Prestige Group and Chairman Credai. Also with us, Amar Mirani, CEO Xander Finance, Vikas Chimakurti, Senior Executive Director Kotak Realty Fund, and Sanjay Gupta, Managing Director PNB Housing Finance. In Delhi studio, Sameer Jasuja, Founder and MD of Prop Equity. Gentlemen, thank you very much for joining me. Mr. Razak, I'm going to come to you first. Slowdown expected to weed out the weak doesn't seem to have happened so far, at least in the first half of 2016.
Yeah, I mean, 2016 so far has been quite good. In fact, the first quarter, that's the new year, January to March, was actually excellent. And so April to June also has been doing quite good. It's like business as usual. You have the highs and the lows. You have certain times. It all depends on what type of product range offering you have. And that excites the market, and then you have a little graph that goes up, a spike, and then again it sort of tapers down. There's no excitement in the market as such, but at the same time I can't say we are down in the dumps. Having said that, like you rightly said, Manisha, there's so many issues that are going to be the developers need to address, starting from the RERA bill and of course seeing our cash flows are positive, and so on and so forth, reduction of debt, or making sure that whatever we are doing, that we deliver to our customers. Because I think today the focus should be of every developer in this country, with all the heat that is on, is somehow make sure that you deliver.
So Mr. Razak, let me come back to what you said, that the first quarter of this calendar year, I'm assuming you're talking about January to March, isn't it? April to June, the numbers haven't got reported yet, sir. Right. But even large players, I mean, when you say the quarter has been good, in what terms do you mean it? Are you looking at sales velocity, value? Because all of you, including the largest, all the listed real estate players, everyone saw a dip down on their net profitability. So what parameters are you using for using that term?
Now, as I said, see, it's the sales velocity. And we as a company as such, we had the maximum sales. I think everybody else had some good sales. And it also depends on what's the type of product that is in the offering on that quarter. I always believe there is demand in the market. It depends on your offering, your pricing, and the location, and all of that put together. Now, some of them probably would have launched something in this quarter, current quarter, and they would have also met with the same success. At the same time, like I said, there's no huge excitement in the market that, the prices are going to the roof, which is fantastic, because we don't want the unaffordability barrier to start hitting the buyers.
Amar Mirani, so I think the last two words are extremely important, good developers. Now, when we talk about the shakeout or shakedown, you might call it either, which was expected in 2016 because of the distress that we saw, slowdown that we saw in 2015. Probably large developers, no one expected either of these companies to actually fold up. They were far away from it. I'm talking about large developers with huge amount of debt, which were the likes of Unitech or JP, or a number of smaller developers who are not listed, whose books are not visible, but one hears of huge amount of stress in their books. Are we saying that insolvencies are not likely to happen?
See, I think what's happened, if you look back in the last 3 years, just rewind 3 to 4 years back, the market was slightly different from what it is today in terms of the kind of product that the developers were churning out in terms of being 4 BHKs, penthouses, large formats, super luxury, which has completely vanished in the last 3-4 years. So in fact, now we have the entire quest towards going to 2 BHKs and 1 BHKs, because that is what the market actually wants, given that the price has not corrected. Had the price actually corrected last 3-4 years, then perhaps this kind of shift in product mix would not have happened. So developers have also aligned their strategies and their marketing focus around the products that they can sell in this kind of a market where the product size and the ticket sizes are constrained from the end user point of view. Second is the investor class has virtually nearly taken a back seat in most markets in India, which was active about 3 to 4 years back. So given, and of course now we have RERA, we have stringent kind of regulations, as well as a more activist customer that has cropped up in the last couple of years. So all put together in a scenario where the prices are not really going up, in fact there's pressure, downward pressure on prices, costs are going up, regulatory costs are going up, margins are thin, and the debt levels are high. Therefore, it is being felt as a kind of a squeeze or a kind of reduction in margins and a kind of very high stress levels amongst many developers who have stocked up on debt to fund their land acquisitions.
Okay.
However, if a developer is sensible on his capital mix and his financing mix, and rational about the kind of product that he's selling in that target market, there is a good market even today for such developers, even if they don't belong to the highest tier 1 category.
Okay. Vikas Timakurti, around December, January, I was having conversations with some of the largest branded developers and the corporate developers who get funding at 10%, 11% and bank funding. They don't even have to come to any PE funds. And even they were saying that business has become so hard, margins have got reduced to manufacturing margins of 9 to 10%. And though that's not something on which, with the inherent risks, real estate is a viable business. I'm hearing a very, very different story 6 months later. So what's going on? I mean, did we read the signs little bit wrong at the end of 2015? Were we too negative, and have we come out of all the negativity too quickly?
Manisha, in terms of the margins, I don't think things have changed from what you have told in December, January, that margins are under pressure. Margins continue to be under pressure. The margins will improve only if the land prices get corrected, and which we have not seen as yet. If at all there are some one-off opportunities where one is looking at higher margins, it is under stress situations where some of the developers are in distress and they are not able to sell, and that's where the opportunities are coming up for larger developers, where they can go ahead and deploy their capital to bail out some of these developers and get higher returns. But purely from a land acquisition point of view, at this point of time, the traditional landlords are not under stress for them to sell the properties at land at lower rates for developers to make margins.
Samir, are we saying that there are no fireworks in store at all? I mean, there's a quiet shakedown which is probably happening, which we know of. I mean, there are local developers already approaching big guys. In fact, Brotin Banerjee's turned around and said, we're getting so many deals. I'm sure Mr. Razak himself gets a lot of local developers from Bangalore knocking at his doors and saying, come, take our land and do just build for us. I'm sure that smile says it all. So is this the way the rest of the market is going to play out, and we shouldn't be worried about a big shakeout at all?
You're absolutely right, Manish. You put it very well. Actually, this era now, next 5 years, you're going to see a lot of branded developers doing exceptionally well. Local developers are going to go out, reach out to them, and offer their land banks or do some kind of joint venture agreements and try and offset the sales, try and make sales happen and get exits of the land banks that they've acquired over the last 4 or 5 years. The demand supply dynamics are playing the biggest role in today's market, which was never the case previously. There was always more demand and less supply. Last 3 years have changed that dynamics across cities. In fact, we were seeing key data points whether you look at Thane, whether you look at Bangalore, and of course NCR, where the committed supply has become in cities like Thane, Bangalore and the south have become 2x to 2.5x of what they used to be in the last 3 years. I'm comparing that to the next 3 years, the delivery that has to happen. And in the NCR region, it's 5 to 6x. So that kind of supply that's committed and has to come, there is no real demand for it.
Sanjay, do you also believe, I mean, there is nothing more that you're going to see in terms of distress in this market?
So Manisha, the first thing that I would say is that the market overall in all segments is not distressed. The segments in which we see distress is the luxury segment and the bottom of the pyramid, as I have been saying it again and again. The mass housing, or where public at large is buying, is doing all right. And we at PNB Housing Finance, we focus on the mass markets, and we are seeing a pretty good traction in that. Even the deliveries are on time. The project completions and the promises made by the real estate developers across the country are now getting delivered. So that's what I would say, on the overall market scenario. But high value ticket items are not transacting at all. And the best example is, Gurgaon in the NCR market, where we hardly see any transactions.
Okay, then let's go back to the new opportunities or how this market is going to get realigned. Mr. Razak, 20-25 big players, you have a realty index in the market, which along with the Sensex and Nifty has of course risen 30% in the last 3 months, despite the fact that all of you, all large listed players, barring maybe one, actually reported a dip in net profitability. So what is it that these investors are seeing which an end buyer as of now isn't seeing about real estate in India?
See, Manisha, even the accounting standards for real estates are very different, because we follow this percentage completion method. So they are, when we launch a project and when it triggers off at the 25% stage, we have a budget that we have on the cost. And then what happens is, if after the 3-year period when the project is almost completed, then you are also revising your budgets based on the the actual costing that's going to happen. And taking the environment that has taken place, invariably there have been cost overruns. So once these cost overruns have taken place, we need to book all these additional costs at some quarter in some quarter. So if you look at, that's why you have this lumpy type of reporting that happens. You have some quarters where a particular developer's profit margin, PAT margin is much higher. And then when the project gets completed, if you have to book in all those additional costs, the PAT margin in a quarter or 2 quarters takes a dip.
So the dynamics have changed quite a bit. The mark segment has changed completely, sir. Secondly, buyers are looking more for ready apartments rather than getting early stage. So there's a huge shift, and one would have assumed that at least 2015, which was fabulous for PE real estate investors, would continue. But if I look at the PERE numbers now, they've dropped to 42% in the first half of 2016 as compared to the H1 of 2015. We just have to do half yearly to half yearly. Now $954 million worth of deals were done in the first half of 2016. They're down from 1.66 billion in first half of 2015. Amar, is it because what Mr. Razak said, everyone's saying, look, let's focus on the right product and selling it to the customer and get our cash flows from there, rather than taking expensive debt from players such as you? How is the market panning out? That whole there was a period where you guys did get amazing mouth-watering deals. Is that done now?
So yeah, Manisha, basically a few factors here at play. I think the first factor has to do with the rise of NBFCs in the last 2 to 3 years specifically. So if you look at it, the kind of money that NBFCs are actually putting out in real estate is going up steadily quarter on quarter or year on year on a definite basis. Second, and also the NBFC kind of terms that the NBFCs offer is better from the developer's point of view as compared to private equity, specifically in under development stage residential projects. Second factor at play is the kind of, if you look at the private equity investments in real estate as a percentage of total private equity investments coming in India across all sectors, that percentage has been steady at between 10 and 15% in the last 4 to 5 years, every year, year on year. So even now, if you say 950 million, and if you take the overall private equity money that's come across all sectors into India in the first half, that same percentage is about 12%. So all I'm trying to say is that overall private equity also would have declined across all sectors in the first half, and therefore the percentage is constant.
Because one would have thought that, you know, this advantageous situation of the weakness would continue, and you PE guys would continue to take advantage of it. But that's really not happening. So how will you actually look for opportunities now? Is it really developers who are strapped to complete their projects? That's the biggest market right now?
So Manisha, in terms of, as you said, the fabulous year for us is only when the capital which is available with private equity investors is low. At this point of time, there is a lot of liquidity which is there in the market, and the number of deals which are there are actually low, primarily more in high yield and debt kind of a strategy. And even in commercial asset acquisition, there is enough amount of capital which is available, and the number of assets which are available are lower. So returns have got compressed, and getting right deals is also becoming difficult at this point of time. So as you said that the challenge at this point of time is that if one is looking for higher return deals, you have to dirty your hands. So which means you need to get into some kind of a situation which is more messy, and work with more stronger developers and try and give them capital to generate returns from those messy situations.
Messy situations which are bothering customers as well. I don't know, Vikas, if you'd like to comment on them, but I mean, two of the largest players in North India which have actually left the market gasping for breath are JP and probably Unitech. Now, are they approaching PE investors?
No, so I can't talk about any specific names, but there are situations like this. But unfortunately, in all these half-completed projects, if there is significant percentage which has got sold, there is not much juice or cover which is left for people like us to give money or work with a stronger hand to turn that around.
Aman, how do you see these stuck buyers getting out? What would be the end solution? Is that worry that the buyers have because they keep writing to us consistently, and therefore somebody needs to give us this answer? How do you see these large two developers actually meeting their commitment? I mean, what happens from here on where people or customers are stuck with these two large developers?
So basically it's a question, it's not, so let's take any of the large developers. They would have certain land parcels which are at a late stage of development, certain land parcels mid stage or early stage of development. So the strategies that they would adopt for each of these parcels would be different. So let's say for the early stage or the mid stage land parcels, they would be more amenable, in my mind, to doing joint ventures or joint development agreements with larger corporate or the larger tier 1 developers in India. And that is what is consolidation all about. So the weaker developers or developers not wanting to finish, not able to finish, selling to the stronger ones. But if it is last mile financing, then there is money available from, let's say, NBFCs or private equity funds towards completing the project, more from NBFCs I would think, for completing the project and giving delivery to the customer. Because what we've seen, especially in NCR in the last year or so, is that when a project is actually delivered, a lot of interest comes in from customers, even in current market conditions.
Sanjay Gupta, would you look at large stage projects with large developers? Would you be willing to finance these, or are you financing these?
Well, our take on large townships is not too great, because generally when large townships happen, their gestation time frame is anywhere between 5 to 7 years going into 10 years term. So, the credit available for that longer term for wholesale banking is not available, because most of us borrow 3 or 4 year money, we cannot lend it for 5-7 years. But large in value is not a problem, and we do look at some condominiums in a large project where they are designing and constructing and going to deliver 500-600 units. We do look at it favorably if it is in the right ticket bracket. if we think that the sales velocities will be good, cash collection efficiency would be upward or north of about 95%, we will not shy away to fund those projects.
Samir, how do you see, I mean, the largest distress seems to be in NCR, and I would think that maximum consolidation one would have expected in this market. There's a lot which is not reported in media. Are there deals happening quite a lot, or they just still, there are developers who are holding on, hoping that things will turn around and somehow they will see light at the end of the tunnel and will not have to go belly up?
Well, you know, like Vikas rightly pointed out, for projects where the structure is already up and the developer is really not being able to complete the project because he's either diverted the funds, those projects are not going to see the light of the day unless the developer goes out there and raises loan from NBFCs. If he's succeeding to sell the land banks, and today, you know, the other problem is that nobody is really buying those land banks because everybody is very scared, especially in the north region, to buy, to be able to sell to the customer, because he doesn't want to buy under construction property, and he has enough options across the board to buy ready properties. In fact, ready properties are cheaper than launches of under construction properties. So it just doesn't make sense for any developer as such to go and buy a land bank. And the bigger developers are doing JDA models. So they are not willing to put in 1 rupee out for the land. They are willing to take and underwrite the risk for sales and profit from and do a profit sharing from the developer who owns the land bank. So the journey is going to be very, very long for those projects to see the light at the end of the day, for projects that have got badly stuck.
Okay. Final word from you, Mr. Razak. I mean, there's this very important point which was brought up in the discussion, that landlords are still not willing to bring down or moderate prices to realistic levels. And till that happens, really, other than resizing apartments, launching products which are probably fit into the budget, there is really no big room to bring down prices. You think that at least if the sales, let's say, value doesn't pick up, sooner than later landlords will also moderate prices, or that's not likely to happen in India?
No, I think that should happen, because I think it's up to us to sensitize the landlord and say, listen, this is the true value, and if you really want to succeed. Now, what really happens is there are many people who are not desperate, who want to try and sensitize the landlord that this is the right number that we can work with, and this is how we can deliver the goods, and it's going to be a win-win for both customer, developer, as well as the landlord himself. But you know, sometimes there are a few people who really are new to the business, who come and create harakiri, and then they commit some wrong deals with some landlords, and that sort of sets off a benchmark. Now, and that deal never takes place, it never happens. And then that's what creates the stress in the market, stress in the system, and then finally those deals get renegotiated. So my message would be that, listen, if the deal doesn't make any financial sense, if you start refusing those deals, automatically the landlords have no choice but to come and work with developers with sensible numbers where it's going to make sense to both. And I think that is most likely it's going to happen and will happen.
Amar, final word. No serious off tracking of business likely to happen. I mean, is the universe conspiring to actually make things better for real estate, interest rates, monsoons, all of that? So can we hope for actually us getting through 2016 without any major shakeout?
Yeah, I think the macro picture is looking pretty good for overall for India and for specifically even for real estate, but over a more medium term, maybe 18 to 24 months after the initial 6 to 12 months. Because if you look at the overall picture, monsoons have been reasonably okay. Interest rates, expectation is that they will be brought down sooner than later. Inflation is looking under control, and more important from a real estate point of view, jobs also are gradually coming in, and the commercial real estate has picked up in the last 1.5 years, and that is normally a precursor towards residential real estate picking up in several markets. So if you look at the commercial real estate story, it's looking very good, especially in the IT markets of Bangalore, Pune, Hyderabad, Chennai. pretty good, and that is normally a leading indicator, as many observants would say.
All right.
So I think the overall picture looks good. We have to just get over the next 6 to 12 months, and various strategies are being adopted by various participants in the market to get over that time frame.
Okay, so next 6 to 12 months, that's the only red zone that we need to get out of, and otherwise then hopefully things will look better and we will get out of this without any big calamity. Irfan Razak, you continue with us for our second part of our debate, but rest of the gentlemen, Amar Mirani, Vikas Chimakurti, Sameer Jasuja and Sanjay Gupta, gentlemen, thank you very much for joining me today. When we come back, we move to the effect the change of guard at the Environment Ministry will have, if at all any, on the real estate sector. Remember, the outgoing Minister Prakash Javadekar did announce a slew of measures hoping to ease the environment clearance for the sector, passing the buck, or I would say mandate, to be more polite, to local municipal corporations. Is that working, and does the industry need anything more from the new man at the helm of affairs, Anil Madhav Dave? Stay with us.